Hello everyone, and welcome back to Accounting Insights with Rula. Today, we're exploring the classified balance sheet, a meticulously organized financial statement that categorizes assets, liabilities, and equity into distinct sections. This structure enhances clarity and holds significant value for comparison and financial analysis, enabling deeper insights into a business's financial health. Join me as we uncover why this format is indispensable for meaningful evaluation. Let's get started. A classified balance sheet is a financial statement that presents an entity's assets, liabilities, and equity in a detailed and organized manner. It groups assets and liabilities into current and non-current categories, providing a clear and structured view of the company's financial position at a specific point in time. This classification makes the balance sheet a more useful tool for comparison and financial analysis as it highlights key financial components. Imagine the classified balance sheet as a tree. Like a tree provides structure and stability, a balance sheet provides a structured view of a company's financial position. The T trunk represents the main framework supporting and connecting each branch. Similarly, the balance sheet framework connects and organizes assets, liabilities, and equity in a balanced structure. On the assets side of the tree, we have current assets, fixed assets, and other assets, all essential resources that fuel the company's growth and operations. On the liabilities and stockholders' equity side, there are current liabilities, long-term liabilities, and contingent liabilities, symbolizing various obligations the company must fulfill. We also see capital stock and retained earnings, which reflect the ownership value in the business, as well as dividends showing distributions to shareholders. On this tree, each flower represents a distinct category within the balance sheet, helping us visualize what the company owns, what it owes, and the value held by shareholders. We often hear the word asset in our personal lives and business. It's a familiar term, but have you ever stopped to think about what it means? Let's start by thinking about some of the things you own. Your house, your car, perhaps a piece of jewelry, or even the money sitting in your bank account might come to mind when you think of assets. But what exactly makes them assets? It's not just about having ownership over something. It's also about value and the potential for future benefit. For instance, your home represents stability and may appreciate over time. Your car provides mobility and remains a tangible asset that could be liquidated if necessary. Jewelry embodies both personal significance and the potential for long-term value retention. Funds in your bank account offer liquidity for current needs or can be strategically invested to foster growth. In a business context, assets can range from physical things like a machinery or a fleet of delivery vehicles to intangible things like patents or trademarks. Each of these assets serves a purpose, helps generate income, or supports the organization's growth in some way. Let's explore what makes an asset essential on the balance sheet and a fundamental driver of business success. An asset is a resource that delivers current or potential future economic benefit to whoever possesses or controls that asset. To qualify as an asset, a resource must meet three essential criteria. First, it must be something that we possess or have control over. Second, it should hold a measurable value, allowing us to quantify its worth reliably. Finally, it must offer economic benefits, whether realized today or anticipated in the future. In accounting, a company's balance sheet provides a comprehensive overview of its assets. which are typically classified into three primary categories: current assets, fixed assets, and other assets. Let's begin with the first category of assets. Current assets, these are resources that a company expects to convert into cash or use up within 1 year or its operating cycle, whichever is longer. While they can vary depending on the business or industry, most companies classify them into these sub-accounts: cash, notes receivables, accounts receivables, inventory, and prepaid expenses. The second category of assets is fixed assets, which are durable tangible resources for producing goods or services. These are often called plant assets, designed to provide economic benefits over a long period, usually more than 1 year, such as property, plant, and equipment. Assets can take various forms beyond the commonly recognized categories of current and fixed assets. For example, a separate classification, investments, may be used for substantial sums allocated to securities or ventures. Similarly, intangible assets such as patents or goodwill often warrant their caption, as do deferred charges in certain instances. When these items are relatively minor compared to the total assets, they may be grouped under a single classification commonly called other assets. For instance, this category can include advances to employees, non-current receivables, or long-term prepaid expenses. These items, while not significant enough to warrant individual attention on the balance sheet, still contribute to the overall financial structure of the organization. Let's introduce a new term into our financial conversation: liabilities. You may have heard it before discussing business finances, personal debts, legal obligations, or even honoring a lease agreement. But what does it mean? In essence, liabilities are financial promises expressed in numbers rather than words. They enable access to resources today while spreading costs over time. For instance, loans for a home or car, credit card balances for monthly expenses, or mortgages for dream houses are all liabilities. Student loans, too, are investments in your future tied to a repayment schedule. Liabilities aren't merely about owing money, they represent obligations, financial commitments with the expectation of repayment. Understanding liabilities goes beyond managing debts. It's about recognizing their role in balancing opportunities with responsibility. Liabilities are not one size fits all. They come in various forms, each influencing our financial narrative differently. Short-term liabilities, long-term liabilities, and contingent liabilities. Let's start with the first category of liabilities: current liabilities. These are listed on the right side of the balance sheet and represent short-term obligations that are due within 1 year or the business's normal operating cycle. These liabilities are typically settled through the transfer of economic resources such as cash, inventory, and services. Current liabilities include key categories vital to daily activities, ensuring the company meets its immediate obligations while maintaining liquidity. Let's start with the concept of accounts payable. Accounts payable is a short-term obligation to suppliers for goods or services purchased on account. A current notes payable is a written promissory agreement in which a borrower receives a specified amount from a lender and commits to repaying it, including interest, within 1 year. The third category is accrued liabilities. These obligations have been incurred but are not yet due for payment. They include expenses like salaries, wages, and taxes, which are recognized at the end of the period but paid later. Withholdings are amounts withheld from employees' pay that must be remitted to government agencies or other entities. They are not company expenses, but should be securely held and transferred to the designated agency. Dividends are payable only when declared by the company's board of directors. Unlike bond interest, dividends do not accrue over time. The sixth category is unearned revenues, which are payments received before delivering goods or services, like subscriptions or advance rent. Unearned revenue is recorded as a current liability if the goods or services will be provided within the next 12 months. It also recorded as a long-term liability if the goods or services will be provided more than 12 months in the future. The portion of long-term debt refers to the segment of long-term debt scheduled for repayment within the next 12 months. This amount must be reported under current liabilities. The second category of liabilities is long-term liabilities. These are obligations or debts that are due more than 1 year in the future and are crucial for supporting substantial financial commitments. Long-term liabilities are incurred to finance enduring investments such as building construction, and their repayment is typically anticipated from future earnings growth. These obligations often bear interest and are accompanied by a fixed maturity date. Long-term liabilities include key categories such as long-term notes payable, mortgages payable, and bonds payable, each representing distinct financial commitments with specific terms and purposes. Long-term notes payable refers to loans that a company must repay over a period longer than 1 year, typically borrowed from banks rather than by issuing bonds to the public. Mortgage refers to loans secured by the company's property with a lien placed on the property, allowing the lender to claim it if the loan is not repaid, while the company retains ownership. Bonds payable are a form of debt financing that corporations, governments, and other entities use to raise capital. The issuer agrees to pay periodic interest during the borrowing term and repay the principal amount upon maturity. The third category of liabilities is contingent liabilities, which are potential obligations that arise from uncertain future events and depend on their outcomes. They are recorded in the financial statements if two conditions are met. The event causing the liability is likely to occur and the amount of the liability can be reasonably estimated. If both conditions are not met, the liability is not recorded but may be disclosed in a footnote on the financial statement. Let's look at this example. Ahmed sells goods to Yusuf for $10,000. Instead of paying immediately, Yusuf gives Ahmed a note receivable promising to pay in 60 days. But later, Ahmed endorses and transfers the note to Rula to settle a debt. Now imagine, 60 days have passed and Yusuf the note-maker cannot pay the amount due. If the note-maker fails to pay, the liability falls back on Ahmed the endorser. Ahmed's liability is only possible before the note's due date. It's called a contingent liability. Since the liability is uncertain, it's not recorded as an actual expense yet. However, this contingent liability cannot be ignored. It must be disclosed in a footnote on the balance sheet to provide an accurate picture of Ahmed's financial position. The final category on the balance sheet is stockholders' equity, a fundamental financial concept representing ownership in a corporation. It's governed by state or federal laws and is typically evidenced by shares of stock. Stockholders' equity has three key components: capital stock, which is the amount invested by shareholders; retained earnings, representing profits kept in the business after paying dividends; and dividends, which are profits distributed to shareholders if applicable. I hope you enjoyed my session. I appreciate you all for listening. Goodbye.